Alrighty, today we're going to be talking about life insurance or death insurance, whatever you want to call it. Life insurance typically. So, life insurance is a type of insurance that you can apply for either inside or outside of superannuation, i.e., superannuation held or personally held. And this type of insurance covers you, or covers your beneficiary, I should say, in the event you pass, they're going to get a lump sum of money. Okay, so generally speaking, and the example we're going to use for today's conversation is we'll say the bloke with the blue jumper on, his name's John, he passes away and he's left his wife and a young child. Okay, so typically speaking, life insurance is there for a person to insure themselves in the event they pass away, and there'll be sufficient funds left over for the people they want to get that money. Okay, so typically, some of the common things to think about when getting life insurance, it's a little bit more elaborate than a lot of people think. I've seen it a lot. A lot of people will have it in their super, typically, and they'll just cover things like their mortgage, you know. And there's a lot of other things to take into consideration. So let's look at the first one, the biggest one, in a little bit more detail. So debts and liabilities. So as an example, if John, in that example, had a mortgage with his wife, all right, they had a house, and they potentially had a car loan and maybe some other personal debts and credit cards. You really need to take these things into consideration because in the event John was the sole income earner and maybe his wife was only working part-time or not working at all and looking after the kids, in the event he passed away, great, he's got his mortgage covered, but what about those other things? So always really important to think about all your debts and liabilities. Okay, the second one is income replacement. So, as you can imagine, it's not income replacement like income protection. This is income replacement for in the event he passes away and he was the sole income earner, how much money will his wife require and for how long? So, as a really easy example, let's say John earned 100k a year, his wife earned 25k a year working part time while looking after the child. In this example, their living costs might be 50 or 70k. Okay, so there's a pretty big shortfall there in the event he passed away. His wife might need to continue working or even pick up full time work or something along these lines just to keep up with the cost of living, which is expensive these days, as everyone knows. So, income replacement can be for things like in this example, a very common consideration is well, John's thinking his child is, let's say, 3 years old. Okay, so we got 15 years till she's 18, as an example. So he might say, well, I'd like, in the event I passed away, I'd like for my wife to be able to continue to work part time, until our child is 18 or finished high school, and then she can go do her own thing, join uni, go rent a place with her, go rent a house with her mates, whatever it might be. But enough time that his wife doesn't have to go and get a full time job or look at other avenues to start to make money. So he's going to say, all right, she's working part time, she earns 20k a year, and cost of living is, let's say, 50k for this example. So she'll need an additional $30,000 a year just to sort of get by, so to speak, or at least comfortably get by. So he'll say, all right, 30k a year for the next 15 years. All right. So in that calculation, you'd be taking into consideration things like inflation and these things because unfortunately 30k now is not going to be 30k in 15 years. We've all seen that. We're in 2025 now, and if you look at the cost of living compared to, say, 5 years ago, it's a pretty substantial difference. So don't forget that in your calculations. Another thing to consider is funeral costs. A lot of people aren't sitting on a lot of money, so if they were to pass away, it's nice to incorporate a little bit of money in your life insurance for funeral costs. Typically speaking, the average cheap funeral these days is still pretty expensive, 15, 20, 25k, whatever it might be. So, up to you how you want to consider that. Education costs, that's another thing. Right now, the family's living costs might only be, like I said, $50,000 or $70,000. But when their child goes to school, if it's public school, won't be obviously too dire. However, if you're thinking about maybe potentially Catholic or private schools, then costs will start to come into place. Okay, so they need to be considered. Another big one is tax. Less relevant for this example because tax for a spouse receiving it, she wouldn't pay any tax, okay? Spouses and children under the age of 18, tax dependents, do not pay any tax on the benefits of a life insurance policy nor the superannuation, okay? and other things to think about. Everyone's got a very individualized situation. The ones I've given you are just examples. They're very common things people think of. Okay. So when you're going for your life insurance, if you do it yourself without professional help, take these sort of things into consideration. Don't just think about your mortgage, okay? Great if you do. As long as you're insured, that's always better than not being insured. But do take these other things into consideration. Now, as I mentioned, tax considerations. We're talking about insurance policies held within super. This is just an easy example. The reason I'm using this is because it's by far the most common way people hold life insurance, especially in Australia. Okay. Now, in Australia, you do not pay any tax if your beneficiary is obviously the spouse or the child under the age of 18 or other forms of tax dependence. So this can sometimes be children with disabilities, even if they're over the age of 18. Okay. But if you've got your spouse or children under the age of 18 nominated, when they receive the funds, there's no tax. However, should you have someone outside of this circle, they may pay tax, typically up to 17%, 15% plus 2% Medicare levy, and potentially other taxes may be involved. Unlikely, but maybe. Okay, so some people sometimes have their brothers, sisters, older people, if you're in your 60s or, retired. You might even have your children still nominated, but now they're adults and they're no longer financially dependent on you. Okay, so it's really important to take into consideration. It doesn't matter how old you are. If you're 30 and you have a spouse and you've nominated her or him, it's going to be tax-free. Likewise, if you're 60 or 70, doesn't matter. Okay. Now, this was just a very brief video explaining how life insurance or death insurance works. You'll see there's going to be a couple other videos that have been uploaded today as well. We're going to cover total and permanent disablement insurance, income protection, and also trauma or living insurance. Okay, these four insurance typically you'll see them held together or grouped. Okay, so people will not just have life insurance or not just have income protection, they'll have all four or a combination of a few of those typically. Okay, now you can only get life insurance, TPD, and income protection. They're the only ones you may be able to potentially get in super. So you see that quite a lot with people who have, automatic insurance in their super funds and things like that. Whereas trauma and living insurance is one that you can solely get outside of super. So we'll go through it in more detail. So you'll see a link shortly where you can click and just go to the next video, but otherwise jump onto the channel and go to the other videos and have a quick look through. And we'll go through a lot of detail. These basic videos are just the start, and we go into more detail in the other videos. Thanks for watching.